Good evening, guys. Let's start with the chapter number 3, that is accounting for employee stock option or ESOP. Short form it is known as ESOP, employee stock option. Employee stock options. Have you heard about this term before? ESOP, as part of your articleship or in general? Yes. So, what does the term ESOP mean to you, sir? Employee stock option. So, by hearing the term, what means to you? What comes to your mind? When company allots shares to its own employees, we call it as employee stock option. Okay, perfect. Name itself is saying employee stock option. So, company is giving some additional shares to the employees for the sweat and blood they are putting in. Correct. Now, employees are the backbone of every organization. You have to be successful means your human resource should be very good. So, they are giving some extra shares. Fair enough. Why are they giving that? Are employees not getting salary? Employees are obviously getting salary, perk visits and 101 benefits they are already getting, right? Why should you think a company should give shares again? To get motivated. How? Because these are not given at free of cost. We charge for it. Okay. Some companies practically also give it at free of cost. But that is not what we're going to be studying here. Alright. We're going to charge some money on that. Okay. So how do you think employees will be motivated? Correct only. Can you elaborate a little bit?
So they get decision-making power.
They get decision-making power. So meaning equity shareholders are the owners of the company. If employees own some equity shares, even they'll have a voting right. So that they're saying they have a decision. Maximum they won't have much decision because the number of percentage of shares they own is very, 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 very minuscule. Small number. So decision still will be taken by board of directors only. It's a sense of ownership. When you go and work for somebody, you feel like, I am the law. It does not belong to us. But suddenly when you become a shareholder, that sense of belongingness comes to you. Yes. So that is one. To motivate. Somebody is saying in online to encourage them to work better. Yes. One of the main reasons why employees or companies do give it is to retain the employees. To retain the employees. How? I'll give you my own option. I used to work for a company, okay? How it worked? But I'll not give you the exact numbers and I'll just give you an example, okay? Yes, I did get this, but not the exact same. The company that I worked for, how it was is, for the first 18 months, I have to work for them. If I stay in that company for 18 months, then I will get 50 shares on the 80th month. This is not the number I got, something different. Leave that portion. Is it okay? So if I stay in that company for about 1.5 years or 18 months, I will get some chunk of shares. I'm assuming it to be 50. Okay. They totally told I have a basket of 300 shares. When I joined, in my offer letter, they mentioned some shares. These many shares I will get. But first installment of shares, when will I get? Only after 18 months. 18 months if I work means I will get 50 shares. Then 6 months later, another 50 shares. Then another 6 months later, another 50 shares. Like this, they had structured. Okay. Is it fine? Now, suppose this 18th month happens to be 31st March 2019. I decided enough of company. I don't want to work here anymore. It is not working out for me. Okay. So, I decided to quit on 31st March 2019. What will my mind say or heart say? Stick around for 6 more months, another 50 shares. Okay. In the meantime, what they had, between this period and this period, they had an amazing strategy. Between this period and this period, there is a 3 months gap. They had a bonus between that. That means what will my idea? Let's say, suppose I want to quit here. Then what will I think? 3 more months if I wait, I will get bonus. Then when I come here, another 3 more months if I wait, 1 more chunk of share. Like this, what happened? My quitting date also got prolonged. Because if a particular employee quits the organization, for the new employee, you need to train. Okay, for the first 2 months, there is honeymoon period only. Nobody will work. Okay, I thought never worked. I was in pool table gym only. Okay, half the time. Yeah, because the thing is, somebody has to train you and everybody are occupied with their own work. And it takes time to pick up new processes. For the first 2 months, is as good as you're just going there and coming, showing your face, logging in, logging out, coming back. Okay, like that. Because it takes some time to pick it up. Yes. So training cost is there, and whether you don't know whether new employee, if you take whether he is good enough or not, we don't know. Yes. So to encourage the employees to stay in your organization, most of the employees do give, or most of the companies do give ESOP. Are we okay with that? And this is the practical, one of the main reasons. Whatever reasons you are telling is also absolutely right. To get a sense of ownership, to make them motivated, okay, to make them work better. All these are also reasons, but primary reason according to me is most towards this. Retention. Because ESOPs, you won't get it in one shot. It's always in installment. Stay for this many months, you'll get that many shares. Stay for this many months more, you'll get some more shares. Like this, they structure. Generally ESOPs. Main motto is to reward as well as to retain them. Got it? Now, this topic, accounting. So, company has given some ESOP to its employee. We need to pass some journal entry for it, sir. That's all. That's all it is. And whatever accounting treatment we are doing here, no, it is backed by ICAI ka guidance note. ICAI, our institute, okay, has issued guidance note on few matters. Earlier, guidance note was also there in your syllabus. Now, they have taken it off. Is it okay? So, they have given guidance note on ESOP. So, whatever accounting treatment we're going to see is as per the guidance note. And one good thing learning about this topic is you also have the same topic in CA final. Ind AS 102, known as share-based payment. You'll study IFRS. Now you'll study accounting standards. In future, CA no, final no. You'll go one step further. So you will hear local standards there. International standards you'll study. Okay. Ind AS we'll be studying. There are a lot of Ind ASs. 102. Ind AS 102 talks about share-based payment. So if you learn properly here, same format. You can use it there also. If you come to me, same thing I'll teach there also. Matlab, same format mein. Adjustments will be a lot more higher there. Leave that. Is it okay? But it's a carryover effect. This topic also has a relevance next stage also. Is that okay? Alright, first is this. So we have got a little background. So what do we mean by ESOP? ESOP is nothing but additional shares given to whom? The employees and directors are also considered as employees for this. Okay, so ESOP means something which is given to directors or officers or permanent employees of the company. So you're giving some extra shares to directors, officers or permanent employees of the company. Do they have an obligation to buy? They just have a right. So meaning if they want, they can buy, or if they want, they can say, I don't want to subscribe your shares. Is it okay? Can they buy now only, or generally it's at a future date? Generally, ESOPs will be given at a future date. Generally, not necessarily. Generally, we say stay for this many months, you will get that many shares. Or let this condition happen, then you will get the shares. Like this, there will be some conditions. Are we okay? And shares, will it be given at market price to the employees? Suppose Wipro ka market price is 300 rupees. At 300 rupees only, we'll give ESOP to employees. Huh? If you give it, no, will anybody buy? They'll say, I'll buy it from stock market only. That means you have to give them at a concessional or a lower value. So ESOPs are given to directors, officers or permanent employees. Through that, what they can do? They have a right to buy those additional shares. When? At a future date. At what price? At a concessional price. This is the definition of ESOP. Not really important, just saying it. Good enough, huh? Alright. Some terminologies will come in your questions, sir. They'll use some terms. Okay. So first, let's understand those terms. Then we will apply them. You'll not get, according to me, you'll not get any theory questions based on this. You'll get practical questions only. But in that question, they will use some new terms. First, let's understand those terms and then apply. Straight away go into the problems. Fine now. First important term is grant. To grant means to give. So you're giving what? Some extra shares to the employees. This is simple English definition. This is important. Grant date. They'll use something. X Limited issued shares to employees, or grant date is so and so, they will call it like this. Grant date means the day. Who am I giving the shares to? Who am I giving the shares to? Employees. Am I giving it at free of cost? Or am I collecting some money from them? Collecting money. That means employees have to give money to me. That means all the employees will buy the shares. Huh? Some of them may buy, some of them may say, I don't want. Correct? So grant date means it's an what? It's a date on which both the parties have agreed. Which both parties? Company as well as the other person. Other person generally is your employees. The day on which the company as well as employees agree to get into this ESOP arrangement. That day we call it as a grant date. Easy? Yes. And normally these ESOP also require shareholders ka approval. Company, no? Yes. So if approval is required means grant date is a date on which approval from the shareholder is also, or the scheme has been approved by the shareholders. Got it? Two features for a grant date. One, both the parties should agree and shareholders should approve. If shareholder approval is not required means then when the day on which both the parties agree, that becomes your granted date. If shareholders approval is required means then both parties should agree as well as shareholders should approve. On the day on which these two criteria happen, that particular date we call it as grant date. Easy. Don't have to mug it up. This terminologies will come. Just know what it means. That's all. Is this fine so far? Okay. Vesting. Vesting means it's a process through which you are giving shares to the employees. That's we call it as vesting. That is not important. Next is important. Vesting period. For simple term, you can write in a notebook. Vesting period means waiting period. Vesting period is nothing but waiting period. And this is one of the key criteria for my accounting. Vesting period. What did I say vesting period is? Waiting period. In my example, can you tell me what is a vesting period? In the example that I gave you, can you tell me what is a vesting period? I have to wait for, if I join today, will I get the company ka share today only or I have to wait for 18 months? 18 months. After 18 months, I'm eligible to buy the shares. If I want, I will buy. Otherwise, I will not buy, like that. So I have to wait for this 18 months, right? That we call it as vesting period. Simple term, waiting period. Is this okay? All right. Next, option. This is the chapter name is employee stock option, not employee stock obligation. Is it option or obligation? Option. Option means employees have a right to buy. They don't have an obligation on their head. If they want, they will buy. Otherwise, they will say, no, I don't want it. Fine. That is your option. Next is exercise period. Okay, let's take a small example here. Exercise period. Let's say Tata Limited granted ESOP to its employees. They told vesting period is, or let's say grant date. Now, is it okay if I use these terms and all? You'll be able to understand. Okay, grant date, let's say, is the 1st April 2021. Are we fine? So, vesting period, let us say, is 2 years. What does vesting period mean? Waiting period. That means employees have to wait for how many? 2 years. That means, can you tell me when are they eligible to buy the shares? After 2 years. That date we call it as vesting date. Can you tell me what is the vesting date? Can you calculate 2 years from this date? 2 years from this date will be 1/4/2023 or 31st March 2023. Is it okay? Are we fine with this so far? So Tata Limited has one employee or 100 employees, or they have thousands of employees. Thousands of employees. If you say vesting date is 1st April 2023, can all that 1 lakh or 2 lakh employees of share or employees of Tata, can they all come together to MG managing director's cabin and saying kudu? Can they do that? Possible, huh? It'll be a fish market. Yes, no. Possible. I mean, you have to give them some time, extra time, because not all of them can buy. Tata Limited told, okay, on 1st April 2023, you are employees, you are eligible to buy the shares. Tata Limited told, I will give you 6 months extra. I will give you what? 6 months extra. Calculate 6 months from this date. It will be 30th September 2023. Is it okay? Tata Limited is telling, I'll give you 6 months extra. Fair enough. That 6 months, if you calculate, it will become 30th September. By 30th September, decide if you want to buy or not. But come 30th September, option will be cancelled. Because after 30th September, gates are closed. You can't buy the shares. Is it okay? Fair enough. This date or this period, what is this period? 6 months? That we call it as exercise period. That we call it as exercise period. Basically, exercise period is nothing but some extra time given. From the vesting date, if you're giving any extra time, could be 6 months, 3 months, 1 year, doesn't matter. That extra time we call it as exercise period. Are we okay? So, alright, let's say one particular employee bought the shares on 1st July 2023 only. He was eligible to buy on which date? 1st April. He thought to. Finally, he concluded what? Okay, we'll buy. On which date he decided to buy? 1st July. The day the employee buys the shares, we call it as exercise date. Because he exercised his right and bought the shares. So, the day on which employees buy the shares, we call it as exercise date. So, with this example, is these things clear? Everybody? Are we okay? Recap. No, what is that? A vesting period is waiting period. What is exercise period? Extra time from what? From the vesting period. If you're giving an extra time, that we call it as exercise period. Fair enough. The day on which employee buys the shares, we call it as exercise date. Okay. So, all right. Employee has to pay some money to buy that. Let's say employee has to pay 100 rupees to buy Tata ka share. Market value of the share, let's say, is 200 rupees. But Tata Limited told, give me 100 rupees, share is all yours. So, employee has to pay how much? 100. That 100 we call it as exercise price. The price at which employees are paying to the company and buying the shares. That price we call it as exercise price. It's given here also. All these terminologies will be utilized, mentioned. Maybe some of them will be mentioned in your problem. So you should get comfortable with that. That's all is the theory you need to know. Because at this level, ESOP ka many provisions have been left out. They've been pushed to CA final. It's very, very simple thing only here. Are we good with this so far? Okay. Next is intrinsic value. Intrinsic value is nothing but, sir, what is the market value of Tata ka share I told? Market value I assumed it to be, or maybe I'll make it as some other number. Hang on. I'll make it as 150 for simplicity. Market value, how much I've assumed? 150. At what price are the employees paying and buying the shares? 100. That means, are they getting any discount? How much discount? 50 rupees. That we call it as intrinsic value of the shares. The difference between the market value and exercise price is what we call it as intrinsic value. Actually, there is a way to calculate this intrinsic value and all. There are two, fair value, intrinsic value, they say. You learn it in SFM of your CA final. You have something known as strategic financial management. There you learn Black-Scholes module, Gordon's module and all. There is some module will be used for pricing all this. You learn it there, not in FR, not in your CA final accounts. You learn it in another paper called SFM, all this. But all this will be given to you in the question. So you don't have to break your head. So for your understanding, what you can think intrinsic for simplicity, what you can treat it as? It's nothing but discount. Actually, market value of the share is how much? 150. Exercise price, meaning how much price is the employee paying? Only 100. The difference between that market value and exercise price, that's what we call it as intrinsic value. Fair enough? Is this okay? For company, can I say this 50 rupees is a loss? Because if it was some other guy, company would have issued the shares at what price? 150. Because it is Tata ka employees, Tata is giving these shares at 100. Yes or no? I mean, Tata is incurring some loss. Yes. That only we need to pass journal entry in this topic. That's all. For that 50 rupees, what you will do, for a few things, what you will do is what we need to consider. That's all as a simple aspect. Got it? Okay. So terms, everything are okay, I believe now. Little bit more theory. Let's afterward dive into the problem. There are three types of ESOP plans, employee stock plans. Equity settled plan, cash settled plan, equity settled plan with cash alternative. I said what? Equity settled plan, cash settled plan, equity settled plan with cash alternative. You learn only equity settled plan in your CA Inter, cash settled and equity settled with cash alternative, CA final. Got it? Alright. Equity settled plan means employees will buy or employees will get equity shares. That's all it is. He will get some additional equity shares from the company. That's all is equity settled plans. Easy. Employees will pay some money and he will get some equity shares. That sort of a plan we call it as equity settled plans. Easy. Just the meaning I'll cover for all the three. But accounting treatment will only do it for equity settled plan because only that much is there in your syllabus. Second one is cash settled plan. Cash settled means here employees will not get shares. He will get rokka, meaning he'll get cash. But how much cash he'll get will be based on the share price of the company. Cash settled plan means employees will get cash. But how much cash he'll get is based on the share price of the entity. That sometimes it's also referred to as SAR or stock appreciation rights or share appreciation rights. All this again in your CA final only, just for your simplicity, I'm just explaining. That's it. For your knowledge base, that's it. SAR. Share appreciation rights or stock appreciation rights. Here, employees don't get stocks. They get SAR, meaning share appreciation rights. How does it? You want to know? Quick 2 minutes, I'll tell you what is this. Is it okay? All right. How this works is, let's say a particular employee has 100 SAR. SAR means what? Share appreciation rights or stock appreciation rights. So how much rights have we given to a particular employee? I assume 100. The day when this right was given, no, let's say when the market value of the share was 150 rupees. The day when this right was given to that employee, how much was the market price? 150. Let's say this right is exercisable after 1 year. Simplicity. This right is exercisable after 1 year. So after 1 year, will market value be same? Or I'll write here one moment. I'll write market value on SAR date. Are we okay with this? Market value on the day you gave this rights, it was 150. After 1 year, what will be the market value? After 1 year, let's say the market value has become 200 rupees. From 150, share price has become 200. Has the share price increased? How much has the share price increased? 50 rupees. That means, will this employee get additional shares now? No. On one share, how much is appreciation, sir? On one share, how much has it appreciated by? 50. How many such rights you gave it to this employee? 100. That means the cash payable to this employee is, if you have given one right, means he will get 50 rupees. How many SARs you gave it to him? 100 SAR. That means the cash he will get is 500, 50 into 100, which is 5,000. So company has to pay 5,000 cash to this particular employee. This arrangement we call it as share appreciation rights. Not there in your syllabus, just for your extra shots. Got it? Understood? Even if you understood, not a big deal as such. Because anyway, you have to learn it after 1 or 2 years. Just it came, I thought I'll explain. That's it. Okay. Third one is equity settled plan with cash alternative. This is like you tell the employees, if you want equity shares, take. You want cash, take. Whatever he wants, he will choose. Or company itself can decide. If company only will tell, if I want, I will give you shares, or if I want, I will give you cash. Whichever option. Whichever company or shareholders will choose. Hence, the name of the plan is equity settled plan with cash alternative. Meaning it's anything could be given as such, in between, or anything rather. That is your third type of plan. Theoretical, not really relevant for your examination. As far as I'm concerned, I don't think so. These are much relevant. Can I move on to the next? Okay. Graded vesting. Graded vesting andre vesting in stages. Like here in my example, I'll go back to the stages. How many shares totally I got, sir? Check the screen. How many shares I got? 300. All the 300 shares I got in one go. I am getting it in installment. This particular vesting, we call it as graded vesting. Meaning giving the shares in installments. If shares are vesting on a different dates, we call that as a graded vesting. Fine, that is the meaning. That's all as far as theory is concerned. Next, straight away problem. Ogana. Anything you want me to explain? Any doubts so far? Online, no? Online also things are clear. Help. Ask it in English only so that like maybe some of the other audience also will get it.
The market value of the share is 150.
Mm-hmm.
The company gives the employer 100 rupees. When the employees, can employees sell them?
Sell the shares. Which one? This he can't sell because is he getting shares or is he getting cash? Here, first example. If he gets shares, he's saying if employees get shares of the company, can they sell it? That depends on the company.
If they sell,
Market. You have some shares, sir. Will you ask me before selling the shares or you will sell it your own? Once you own the shares, it is your asset. You can do whatever you want with it. You sell it, you donate it, you keep quiet, you forget about it. Your issue. Fair enough. What you do with it is your call. Okay. But I thought what you are asking was, sir, when can they sell it is what I was thinking. It's their assets and they can do whatever they want it. Sell or keep it. But some companies also give post-vesting restriction or lock-in period, they say. If I get the shares today, I can't sell it for 2 years, 3 years like this. They put some restriction. That is post-vesting conditions, we call it. Okay, I thought your question was based on that. Okay, any which way. Is this okay? Jen, no problem. Okay, so you can sell it also, you can keep it also, you can do whatever you want with it. It's your asset basically. Sir, after the employees get the shares from the company, when he leaves the company, will they get back the shares, sir? No, once you get the shares, it is yours, sir. Generally, like, a company will not ask you to will not ask you to refund those shares unless the clause says so. It could be structured like that, but generally once you get the shares, it becomes it's yours, means there will not be such restriction as such. Okay. If you are having such company, better before leaving the company, sell those shares and then go. That's what I did. I sold the company shares and then only left. Okay. Anyway, because mine was a US listed one. That's the reason I was a little scared about the other things. That's the reason. Okay. Anyway, are we comfortable now? Can I move on to the next one? Okay. The problems now. Question number 1. But before the questions, one point you need to check in your ESOP problems. First, you need to check whether vesting period is less than 1 year or more than 1 year. That is one thing you need to always check. What did I say? Check if vesting period. Check if the vesting period. You don't have to write this down. I have already brought it in the chart. Okay, you can just listen, or if you still want to write it in your notebook, absolutely no problem. Check if the vesting period is less than 1 year or more than 1 year, because accounting will slightly vary. That's the reason you need to check whether vesting period is less than 1 year or more than 1 year. Vesting period means the waiting period. First, that's what you're going to check in these sort of problems, and then only proceed with your accounting. Easy. Can we start with question number 1 now? Okay. Come back to question number 1. A company has its share capital divided into shares of 10 each, meaning the face value of each share is about 10 each. Okay. On 1st April 20x1, it granted 10,000 employee stock option. 1 minute. What is this 1st April 20x1? It is what we call it as a grant date. So grant date is 1st April 20x1. Find how many stock option was given to employees. 10,000 stock option was given to employees. At what price? 40 rupees. What is this 40 now? It is a price the employee pays to buy the shares. That is nothing but that only we call it as exercise price. Okay, sometimes they will give like this, sometimes they will only directly tell exercise price is 40. Hence, it's good to get used to those terminologies. So exercise price is about 40. But however, what is the market price of the share? 130. That means 130 worth of share you are giving to the employees just at 40. Huge discount. Yes. Fine. Alright. How much discount by the way? 130 worth of share you are giving only 40, means the discount is 90 rupees per share. The options were exercised between, check this date, options were exercised between 15th March and 31st March. Sir, 15th March to 31st March, they're exercising means it's already vested. Correct? No. When will you exercise it? Before vesting or after this? Exercising means buying, sir. When can you buy? After vesting date only, no. So here, check. What is the exercise period? 15th March to 31st March is the time. Correct? So now one moment. What is the grant date, sir? Grant date is 1st April 20x1. And employees bought off all the shares. By when did they buy the shares? By 31st March 20x2 itself. This is what? It's an exercise period. Yes. That means vesting is much before that. Now you tell me whether in this problem vesting period is less than 1 year or more than 1 year. 1st April 20x1 to 31st March 20x2. For simplicity, I told you can assume x2 to be, for this decade, you can assume it to be 2. So if you want, you can write 1st April 2022 or 2021, and here it will be 31st March 2022. Don't write like this in examination, just for understanding. So that means less than 1 year or more than 1 year? Less than 1. That means one sort of accounting we have to do. If it is more than one year, another set of accounting. First observation, is it clear? Move on to the next. Yeah. Alright. The employees exercise their option only for 9,500 shares. How many options you gave it to the employees? 10,000. It is an option. It is not an obligation. You gave 10,000, but they bought only 9,500. Maybe some of them quit or some of them don't want to buy. Reason could be anything. It doesn't matter to us. So 9,500 shares only they purchased, and the remaining options, did they buy it? They don't buy it means it will get cancelled. But instead of saying cancelled, they'll use the word lapsed. Okay. So company closes its books on 31st March every year, and you need to just pass some journal entries. Can I pass it off here only? Or maybe it's okay. Question number 1 ka solution. Journal entries in whose book, sir? They have not given, no? Okay. Journal entries. You just write journal entry or else. Or maybe, hang on. One moment, hang on. Let's get some base working notes ready. Not required, just first problem, no? So we'll make some base working notes. First, maybe simple things. First, we'll write. All this you don't have to write in your examination. But just since it's the first problem, we are writing. Grand date is how much? 1st April 20x1. They can buy how many shares? Or rather, like, you know, they can buy the shares at what price? Employees can buy the shares at what price? 40. That 40 only we call it as exercise price. So exercise price, or maybe first we'll write down market value. It will be easier for presentation. Next presentation. I'll call this as 1. I'll call this as 2. Market value, do you know? Market value is about 130. How much is exercise price?
40.
Exercise price is about 40. Is there any discount here? Instead of discount, either we can call it as intrinsic value, or you can call it as fair value of the option. We'll use this term only because this is the terminology you'll be using for going forward in CA final. Our material uses both, so we'll stick to this so that it'll same things and all will stick around in the long run for you. Fair value of the option is nothing but discounts. That means how much is it? Can I write what? 4 is equal to? Can I write 4 is equal to 2 minus 3?
Yes.
2 is nothing but your market value. 3 is nothing but exercise price. If you do that, how much you're going to get? 90 rupees is the fair value of the option, rather discount of the option in a way. This is the base data. Once these base data is done, then we'll go ahead and pass journal entry. So every time you have to do it. Check the problem. I doubt they'll ask you such questions. This is just a starter, appetizer. They will not ask you such questions according to me. Some other questions is there that probably may get asked. Why are we doing it, sir? They may ask. Yeah, generally they don't, but sometimes the institute will show too much mercy on you also. No, they'll ask very, very simple questions sometimes. Okay, no. Okay, she's saying no. That means they didn't show it to me, she's saying. No worries, happens sometimes. Journal entries. Yes, first journal entries. Or have they given the date? Have they given the date?
Yes.
They told employees buy during which date to which date? 15th March to 31st March. One date they gave, or they gave a period? That means I'll also write the same period. Between 15th March 20x2 to what? 31st March 20x2. They have not given the date, means what can I assume? Sir, I want to assume 31st March, right? Who told you? Yes. They have not given specific dates, I've just kept the same thing. Fine now. Now look at this entry. On this particular day, employees will buy it. Employees will buy the share. If employees buy the shares, means company will get money. So that means the first journal entry will be bank account debit. How many shares did you offer it to the employees? 10,000. Did they buy all 10,000 or just 9,500? Just 9,500. And on one share, how much will employees give the company? 40. So that means money you're going to get is 40 per share. So 9,500 it will be. 9,500 into 40 will give you a number of 3,80,000. 3,80,000. Leave one line, or first check and then copy. What has the company issued here? Equity shares. If company issues equity shares, what will they credit? To equity share capital. How many shares was given? Don't write 10,000. They bought only 9,500. Share capital always at face value. What is the face value of one share? First line only they told. 10 rupees. That means equity share capital will be credited to the extent of 95,000. Okay. 2. Securities premium. To securities premium. Sir, if it was, just listen to this. If it was not an employee, but some other guy, at what price do you think the company would have issued the shares? 130. Yes, face value of the share is 10. We would have issued it at 130. That means the company would have got a premium. How much premium per share? 120. That is all we have to write here. In 950 into 120. How much is it? 950 into 120. How much is that? 1 lakh? No, or rather it is 9,500. No, this is 9,500. My bad. Hang on. So this is 9,500 into 120. How much will that be? 1 lakh? 40. One number. One number. Elipa.
11 lakh 40.
11 lakh 40,000. Sure. Okay. Can I move on? Is the journal matching or there is a balance? Balance. So you are giving some shares at a discount to the employees. Why? Because it is your own employees. That means company is bearing a loss here. That loss, as per nominal account rule, what do you have to do for that loss? Ignore it or account it. Loss should be debited or credited as per nominal rule. Debited. That loss we call it as employee compensation. Employee compensation expense account debit. Employee compensation expense account debit. How many shares did you give it to the employee? 9,500. How much is the discount you gave it, sir? 90 rupees. So you do 9,500 into 90. How much you're getting? You're getting how much? 9,500 into 90. 8 lakh 55,000. Now journal entry should match. Check. Did you understand it? So you are giving shares at a lesser price. That means your company is facing a loss. That loss should be accounted and the security premium has to be accounted. Is the security premium realized in cash? Partly. Because you are getting only 40 rupees. But you are crediting security premium to the extent of 120. So it is partly realized in cash and partly other than cash. That means can you use it for bonus issue, sir? No, I think that was in group 1. No? Morning batch. Okay, no problem. Leave it. Okay, I will not speak that. Okay. No issues. Okay. So far good. So far good. This is your simple problem. Yes. How did I get this 120 by the way? If any of you are wondering. Market value of the share is 130. Face value of the share is 10. So 130 minus 10 will give you 110. That's your security premium. And what is this 90 rupees? It's the loss the company is bearing because it has given some shares at a lesser price. Market value is 130. We gave it to the employees at 40. So the loss the company is bearing on one share is 90 rupees. That's what we are debiting. On one share it is 90. On 9,500 shares it will be 8,55,000. Easy now. Okay. One more entry, sir. Oh, give narration. Okay, write down. Being 9,500, or maybe we'll write it in different ink. Being 9,500 or 9,500 ESOP purchased by employees accounted. Or you can add more masala also. What is it? At an exercise price of 40. Like that also. At a fair value of option of 90. All that mirch masala also, if you want, you can add. Or you can stop it here. That is also sufficient. Okay. Normal narration. Nothing extra as such. Okay. One more entry. Can I go? Can we do? 15th March 20x22. Again, one more entry ka date also they have not given. So I'll write the same date. So did you get any loss in this problem? That loss only we're calling it as what? Employee compensation expense account. Yes. All loss goes where? P&L. So the next journal entry is transfer to P&L. What is the journal entry to transfer any expense? Perfect. P&L account debit to employee compensation expense account. Employee compensation expense account. How much was that employee compensation expense? So 8,55,000. You debit and credit. That's it. Easy, The narration, if you want, what you'll write? Being employee compensation expense transferred to P&L. That's it. Being employee compensation expense transferred to PRL. Transferred to P&L. That's your narration. Problem over. That's it. A very, very simple problem. Doubtful that this will come in examination. But unless they combine it with maybe another topic. That could be a reason. Yesterday we saw. With buyback of shares they combined. Okay. But that is not the entry I passed. I passed a different entry. Okay, I will also tell you that. We'll do 2-3 more problems. After you go home, check that entry. Then you will understand. From the time being, you don't have to flip the pages. Yeah, you'll not understand it any which way. Okay? Over a problem. This is the journal entry when the vesting period is less than 1 year. Okay, let's go for the next question. Hang on. Which question I'll tell you? Arihant Limited. We'll do that first. Question number 3 will start off first. Arihant Limited has a share capital divided into equity shares of 10 each. Oh, by the way, no questions, right? Simple enough? Everybody? Online also everything is okay? Simple case? Okay, I'm thinking they have it. All right. Arihant Limited, next question, question number 3. Arihant Limited has a share capital divided into equity shares of 10 each. So 10 is your face value. On 1st October 20x1, it granted 20,000 ESOP. So what is 1st October 20x1? We'll call it as GD, not JD, GD. Now master has taken over, no? They keep changing JD and all. All right. So GD is grant date. So how many options was given on the grant date? 20,000 employee stock option. At what price was it given? At 50 per share. So what is this 50 known as? Instead of writing full form, I'll write EP. EP as in exercise price. When the market price was 120 per share. Market price was 120, but you gave it to the employees at 50. That means, are you giving it any discount? 70. That we call it as either intrinsic value of the option or fair value of the option. Fair value of the option we'll write, which is 70 per share. All right. The options were to be exercised between 10th December 20x1 and 31st March 20x2. Check the grant date, sir. When is a grant date? 1st October. By when they need to buy off? Not even vesting date. By when they need to complete it off? 31st March. You gave it in October. You're closing it out by March. That means less than 1 year. You don't have to calculate exact months. Less than 1 year or more than 1 year. That's all you need to know. Here it is less than 1 year. How? Count from this 1st October 20x1 to 31st March 20x2. You'll only get 6 months. Since it is less than 1 year, what is the journal entry? Same as the last problem. One more problem for additional practice. That's it. The employees exercised the option for how many shares? 16,000. How much was given to them? 20,000. But they bought only 16,000 and the remaining options got cancelled or lapsed. Company closes the books on 31st March. Show journal entry with narration as on 31st March. Same scenario. Yeah. Okay. I'll do it parallelly here only. Question number 3, right? Question number 3 ka solution. Now all the data is required or directly we'll do journal? Directly journal. What is the date they told? 10th December and 31st March. Okay. The period, if they tell like that, I'll write the same date. 10th December 20x1 to 31st March 20x2. Among this one day, employees, whichever day employee will buy. I don't know the date, hence I'm keeping that period as it is. So, but when employee buy, what will happen? The company will get money. So the journal and this one will be bank account debit. How many shares do the employees buy, sir? 16,000. At what price? What is the exercise price at which they'll buy? 50. So that means 16,000 into 50 is about 8 lakhs. Then what will we debit again? Company is making a loss. The name of that loss is employee compensation. Employee compensation expense account debit. How many shares? 16,000. All right. So the market value of the share was 120. It was given to the employee at 50. That means what is the fair value of the option? Or what is the loss for the company? 70. So 16,000 into 70 if you do. How much is 11 lakh? 20,000. 11 lakh 20,000 is employee compensation expense. What did the company issue here? Equity shares only. That means what will they credit? To equity share capital. Number of shares is 16,000. Each share ka face value is 10 rupees. That means this will be 1,60,000. To what? To Securities premium. Number of shares is 16,000. What was the market price of the share? 120. So what is the face value of the share? 10. That means the premium will be taken as 110 rupees. 120 minus 10 rupees. Market value minus face value is your premium element. So this will be how much? 17,60,000. Journal entry should ideally match out. Somebody is telling, sir, the 10th December is not required, no date. You have to pass this entry when the employees buy. On which day employee buys, they have not given. They told employees bought between this date. Since I don't know the date, I have kept the same period. If you want to assume they have purchased on 31st March, you write 31st March. It is okay. Alright, that's all. Or one more entry. This is first journal entry. Second journal entry is what? Transferring the expense to P&L. The transfer entry is P&L account debit to employee compensation expense. How much is that employee compensation expense? 11,20,000. Narration I have not written. It's because it's a simple one. Same repetitive problem. That's it. Just for practice. Can I move on to the next questions? Next sort of questions. Okay, we'll come to question number. We'll come to question number 2. Important. These sort of questions you can expect in examination, like question number 2 onwards. According to me, if it comes for anything above 6 to 8 marks, these sort of questions generally get asked. Let's read it. ABC Limited grants 1,000 employee stock option. As on which date? 1st April 20x0. That only we call it as GD, as in grant date. At what price? 40. That 40 only we call it as exercise price. How many options was given to employee? 1,000. So all those are required. So let me box that. When the market price was 160. Market price was 160. Exercise price is only 40. That means how much less you are collecting for employees? 120. That 120 itself is fair value of the option or loss to the company. The vesting period is 2.5 years. Last 2 problems in vesting period was less than 1 year. Here vesting period is clearly given to be 2.5 years. The maximum exercise period is 1 year. Meaning on the vesting date, employees will be eligible to buy. After vesting date, company is giving further extra time. How much extra time? 1 year. That is your exercise period. So by then, employees should make up their mind whether they want to buy it or not. If they don't make up their mind, automatically options will be lapsed or cancelled. Exercise period and all is irrelevant for me. The most important component as per the guidance note or for employee stock option is vesting period. What is vesting period? 2.5 years. That is very, very important. 300 unvested options lapsed. Maybe some employees quit because its waiting period is 3.5 years. No? Between 3.5 years, many employees join, many employees quit. Maybe some employees who were given this option quit. If they quit means will they get it? No. So maybe they had 300 options with them. So hence the 300 option has become unvested, meaning cancelled basically. So it got lapsed. As on which date? 1st May 20x2. Okay. Totally you gave how much? 1,000. 1,000 May how much got lapsed? 300. What remains? 700. So at least we thought, okay, 700 maybe they will buy. Next, what did they say? 600 options are only exercised. We thought 700 will buy, but ultimately how much? What happened? Only 600 of them only bought. As on which date? 30th June 20x3. 100 option because 700 we thought, no? 700 minus 600 is 100. That 100 option also obviously will get lapsed. That 100 vested option lapsed at the end of the exercise period. That 100 also got lapsed. Past journal entries. Though the problem is only 4 lines, no? Solution will be 2 pages. That is the beauty of this. Okay, like that. That's the reason they ask this sort of questions. Got it? Not difficult. It is just that same journal entry you have to repeat. Because 3.5 years now. That's where it will be long. That's the reason. Not difficult, just lengthy. That's all. Okay. All right. Listen to this. You have almost 3 problems like this. Future men. One problem, if you understand properly, other things will be just more or less the same thing. Okay. I'll insert the page maybe here. This is question number what, sir? 2. Question number 2 ka solution. I will make you a table. All these questions are from your study material only. Study material has good questions. I have not referred any other book. Study material questions are only good. We have covered all the things. Illustrations, practical questions, everything here. All the types. I should be very careful there also. No point in doing repetitive questions. I told you on the day 1, I'll cover every type of questions. So that I will give you. Is that okay? Study material questions are good. Answering pattern is not that good. Okay, they will just present one question in one format or one way. So you will not be able to understand. It will be difficult. So what we will do for these sort of problem is I will put up a table. The table will stay with you still CA final. Same table for India is 102 also. If you come to me, I'll use the same table. Okay, depends. Yes, are we okay with this? That's the reason the table. Same table. Any sort of questions, any sort of adjustments. If you know the table, it will be captured. They can tweak, twist, whichever way. Follow the table, it will follow. Okay. I'll just put up this table for you. Working note, we'll call it as what? Working note number 1, I'll call it as employee compensation expense. Employee compensation expense. Okay, before I maybe put up this working note, one thing I'll just tell you. How much is vesting period here, sir? 2.5 years. Sir, while issuing the shares to the employees, is company making any loss? Yes, because what is the market value of the share? 160. At what price was it given? 40. That means on one share, how much is the loss company is making? 120. Yes. So, or just for simplicity, how many options got exercise, sir? 600. This working note is slightly different. Just for simplicity, I'm telling you. If you do 120 into 2, I think you're going to get 72,000 or 7,20,000. 72,000. Just, this is not the correct working note. Don't copy this and all. Simplicity I'm taking. I'm assuming 600 shares are purchased. Okay, on each share, how much is the loss? 120. So what is the loss? 72,000. Can you transfer? Loss means where it will go, sir? P&L. Can I transfer this loss to 1 year P&L? Touch your heart and tell. Don't still say yes. Okay. Why? Sir, vesting period is 2.5 years. That means they have to wait for 2.5 years to get the shares. Yes. So the time gap is what for these options? 2.5 years. Loss is how much? 72,000. That means does this loss belongs to 1 year or it belongs to 2.5 years? That means you have to amortize this loss over 2.5 years. You can't book it to 1 year P&L. You have to distribute it over 2.5 years. Meaning you have to transfer it to 3 years ka P&L. That's the funda. That's the reason we always check vesting period is less than 1 year or more than 1 year. If it is less than 1 year, everything will go to 1 year P&L only. So you don't have to break your head. But suppose vesting period is 2.5, 3.5, then it will be amortized to many years of P&L. That's the funda. That's what we are doing here in the going forward. Got what I'm trying to do here? All right. Can I put up a note now then? Okay. We have already copied the note. Employee compensation expense. If you want, just check first and then make the table. Particulars. What is the grant date here? Grant date was 1st April 20 X1. So now we got to know what? Expense has to be booked over how many years? 3 years. First year is ending on which date? 31st March. You gave it on which date, sir? Grant date was 1st April 20 X0. That means year will end on 31st March 20 X1. Yes, no? X0 means it will end on X1. X1 means it will end on X2, like that. Second year, 1 year P&L you will transfer or 2.5 years? That means one more table unit, one more column you need to have. That year will end on 31st March 20 X2. That's all, or one more? One more, which is year 3. So year 3, don't write 31st March. Okay, no problem. Calculate 2.5 years from the grant date. It will be 30th September 20 X2. Or if you don't want to write, you can write 31st March 20 X3 also. Absolutely no issues. Because you prepare P&L when? Year end. Unless you are a listed company where you give quarterly statements. Yes. Most of the other companies prepare financial statements on a year-on-year basis only. Are we okay? So that means 3 years, these many columns have we made? These many columns, okay, make actually these many columns in your notebook first. First write down, listen to one problem fully, then ask whatever doubt you have. In between, don't worry about this or that. Stay with me for one problem first, properly. Then ask whatever doubt you have. First understand what I'm saying. Particulars, year 1. Year 1 is ending on 31st March 20x1. Year 2 is ending on 31st March 20x2. Year 3, if you want, you can write the same. 31st March 20x3 only. Or, I've calculated 2.5 years from grant date. Grant date was how much? 1st April 20x0. If you calculate 2.5 years from this date, the 2.5 years will end on 30th September 20x2. That's the reason I've written 20x2. Fine. If this is confusing for you, you can write 31st March 20x3. Absolutely no issues. Made those columns. Okay. First one. Same format. Okay. First one. Number of options expected to vest. Number of options expected to vest. Number of options expected to vest. How many options was given to the employee, sir? 1,000. Now you are in the first year. First year is ending on which date? 31st March 20x1. Check if any employees left or any options got lapsed. They said some option got lapsed. How many options got lapsed? 300. But it got lapsed on which date? 1st May 20x2. That means I'm in which date now? 31st March 20x1. On x1 only did I know? Or what would be my understanding as on 31st March 20x1? None of them have lapsed. That means how many of them will buy? 1,000 shares. 1,000 shares would be purchased is my idea. Yes, no? Because it got lapsed only on 1st May 20x2. So on this date, I'm still thinking 1,000 shares are only going to get purchased. Is a all right. How I'll do it parallelly here or okay, no problem. Hang on, I'll just next one also I'll write. Next one, fair value of the option. Fair value of option. Fair value of the option means the discount. Yes. What was the market value of the share? 160. How much was exercise price? 40. That means the fair value of the option is 120. How did you get 120? 160 minus 40. That means fair value of the option is 120 under every case. Okay. Or okay. This we can write off. It's okay. All right. Third one. So fair value of the option means loss. Loss. So loss on one share or total? The 120 per share or total? Per share. No. On one share the loss is 120. How many shares you thought employees are going to buy first year? 1,000. That means what is total employee compensation expense? Total employee compensation expense. Total employee compensation expense. 1,000, check this. 1,000 into 120 into 1 by 3. 1,000 into 120 into 1 by 3. How many of you understood this 1 by 3? Now, on one share, how much is the loss? 120. How many shares are there? 1,000. So 1,000 into 120 means you're going to get how much? Total loss. Which is how much? 1,000 into 120 is 1,20,000. Entire 1,20,000 you'll book it in 1 year P&L only, or it will be amortized? Amortized. Over how many years? 3 years, or rather, how much was vesting period here? Oh, sorry. Then this should not be 1 divided by 1.3 Allah. This should be 1 divided by, basically you should amortize the expenditure over the vesting period. How much is vesting period? 2.5 years. That means 1 divided by 2.5. Easier. Basically, how much over? 1,000 into 120 if you do, you're going to get 1,20,000. At 1,20,000, you have to amortize it over 2.5 years. So 1,20,000 divided by 2.5 if you do, you're going to get 48,000. Why did I write 1? Why did I write 1? Because for first year name, always you should count the period. This period, no, you should count from the grant date. Next problem, you will do a mistake. That's the reason I'm clarifying now only. Okay. How do you calculate this one? Take the grant date, count it till the end of the year. From the grant date, count it till the end of the year. When was the grant date? 1st April 20x0. From 1st April 20x0 to till 31st March 20x1. How many years? 1 year. Is it necessary granting should always be at the beginning of the year every time, or it could also come in between? Yes, so that this will not always be 1. It could be anything. Always just check. In a problem, generally it will be 1 or 0.5, because sometimes they will give grant date as 1st October. That also is there. One problem it is there. You will make mistake. That's the reason I'm telling you here only. Is this okay? How did I get 1? You should count it from the grant date till the end of the year. Yes, grant date was 1st April 20x0. End of the year is 31st March 20x1. Hence, this is 1. You are in first year, no? Hence, how much is this you're getting, sir? If you do this, how much you're getting? 48,000. Easy. 1 minute. Don't. Next is employee compensation or expense recognized previously, you're right. Expense recognized previously. Expense recognized previously. Sir, you are in which year? First year. First year you already recognized expense, or first time you are recognizing? That means expense recognized previously is 0. It will have an impact for the other 2 columns. For now, time being, right? Fifth one may expense, or if you want you can write employee compensation expense. Employee compensation expense to be recognized in current year. Employee compensation expense to be recognized in the current year is 5 is equal to 3 minus 4. 5 is equal to 3 minus 4. 3 is how much? 48,000. 4 is how much? 0. 48,000 minus 0, if you do what, you're going to get 48,000 only. This is okay. Last 2 columns you might have not understood properly. It is okay. When I come to the next column, automatically you will get it. Numbers are looking fine to you. Okay. How did I get this 48,000? Curious? Just tell once again. 1000 into 120, if you do, what are you going to get? The total loss. That is 1,20,000. That total loss has to be amortized over vesting period. Here the vesting period is 2.5 years. If the vesting period was 4 years, then what would be your denominator? It would not have been 2.5. It would have been 4. If the vesting period is 7 years, then your denominator would have been 7. This is your denominator. How about your numerator? 1. How did you get 1? From the grant date till the end of the year you need to count. Easy. Okay. So that's how you got this to be 1. Can I go for the next one? Okay. First year expense are booked. Based on this only I will pass journal entry. Journal entry is very, very easy in these sort of problems. This working note only is major, because journal entry is repetitive. Same journal entry you'll pass again and again and again. That's it. So we'll come to the next year. Next year is ending on which date here? Which year, sir? Which date? 31st March 20x2. Now check. On 31st March 20x2, how many options the company feel employees will buy? On 31st March 20x2, any information about lapse is given, no? They told how many options got lapsed, sir? 300, but dates are important. Check. 300 unvested option lapsed, but they lapsed on which date? 1st May 20x2. 1st May means it comes on this date or after this date. That means on 31st March, company still thinks what? 1,000 employees only or 1,000 shares are only going to get purchased. Yes, because lapse information came on 31st March. That is 2 months later. Hence, here also 1,000 only. Easy, yeah. Okay. What is the loss on 1 share? Or what is the fair value of the option? 120 only. Meaning 160 was a market price. You gave it at 40. Hence, the loss on 1 share is about 120. So, how many shares totally? 1,000 shares. What is the loss on 1 share? 120. This loss has to be amortized or booked over how many years? 2.5 years over the vesting period. Hence, denominator is how much? 2.5. Numerator will be from the grant date till the end of the year. If you count, how much it's going to be? Grant date was 1st April 20x0. From 1st April 20x0, if you count 31st March 20x2, 1st April 20x1 to 31st March 20x1 is year 1. Then again till 31st March 20x2 means it becomes year 2. I mean, numerator will be what here? 2. Easy. Alright, how much is this now? 1 lakh into 1 or 100 into 120 if you do, you're going to get 1,20,000. 1,20,000 into 2 divided by 2.5 if you do, you're going to get 96,000. Why 2 I have written? Because you are in which year now? Second year. That means 2 years ka expense should be fully booked. So I've written here, check, I've carefully written the words. What word I've written? Total employee compensation expense. You are in first year, so total employee compensation expense is 48,000. You are in second year means, total means what? First year ka plus second year ka. Correct, no? So total employee compensation expense for the, when you are in second year is how much? 96,000. For 96,000 you will pass journal entry. No. 96,000 is what? Expense for 2 years put together. Yes. How much is the expense recognized previously? Previously means year 1. In the first year, did you recognize any expense? How much did you recognize? That you will write it here. You have already recognized 48,000 in year 1 itself. By the end of second year, you should have recognized 96, but you have already recognized 48. That means how much more you need to recognize? That is nothing but 5. 5 is nothing but 96,000. 5 is equal to rather 3 minus 4. 3 is 96,000. 4 is 48,000. I'm denoting. So 96 minus 48 if you do, how much are you going to get, sir? 48,000 itself. Manageable, easy. Any sort of adjustment, lab, skips, everything this table will take care of it. So you don't have to worry at all. But if you don't put up this table, confusions will start coming in. Hence we're going to solve like this. Okay. Later don't check. Study material they are not doing anta bandi helbedi. Telling you final answer you check. Between my final answer, study material answer will be same. How we get it, we have our own methodologies. Okay. Can we get to the third year now? Okay. Now we are in 30th September 20x3, or some of you would have written already what? 31st March 20x3 also. Whatever is your comfort you would have written. Doesn't matter whatever you write. Easy? Okay. Now, as on 31st March 20x3, as on 31st, it's actually better if you write year ending only than 30th September, according to me. Because lapsed information and all they'll give between them. So it's always good. According to me, it's much better to write year end only in the third column to avoid all confusions. Okay. My suggestion is that. But either ways, it's okay. Alright, coming back here. You are on which date now? 31st March 20x3. Still you think 1,000 stocks are going to get purchased? Huh? Check if anything got lapsed. 300 got, where is this? Question number 2 we were solving. No? 300 got lapsed. When did they get lapsed? 1st May 20x2. You are on which date now? 31st March 20x3. That means do you know about this information? Yes. Initially you thought 1,000 will buy. But now you got concrete information that how much has got lapsed. 300 has got lapsed. Easy. Alright. Next, 100 also got, they said no lapsed. But when it got lapsed? Check here. First of all, 600 option exercised on which date? 30th June 20x3. 30th June, you got to know. I'm in which date now? 31st March. 30th June means 3 months later. 3 months later, I got to know that 100 options more also got lapsed. But as on 31st March, I am still thinking what? 700 options are going to get purchased. Yes or no? Hence 700. Easy, everybody. How I got 700? Because these 300 options are lapsed, meaning it has got cancelled. But the loss on one share is still 120 only. Okay, we have 700 shares. Basically, next column is the total employee compensation expense. On one share, how much is the loss? One share, the loss is 120. We have 700 shares. This if you do, you're going to get what? 84,000. But what is that? It's a total loss. That total loss has to be amortized over how many years? 2.5 years. You are in which year now? Last year only. That means here, if you want here, you don't have to write anything. If you want to write, you will write 2.5 divided by 2.5. If you want to write. Otherwise, this portion you can skip. Because last year means full expense you should have recognized by now. No. So no point in writing this. Want to write like that. Easy. Okay, how much is this now? So what is this 84,000? Total employee compensation expense. For what? For 1 year, 2 years, or all the 3 years? All the 3 years put together, the expense is how much? 84,000. Okay. But how much have you recognized? Next column is expense recognized previously. In the previous year, how much expense you have recognized? First year you recognized 48. Next year you recognized 48. Or if you don't want to do that, you can check here only. How much is this number? 96. If you add these two, automatically you're going to get this only. Because this is second year ka expense now. 2 years put together ka expense this is. Yes. Either do it like that or count individually. First year the expense is 48. Second year expense booked already is again 48. So the total expense booked already is how much, sir? You've booked how much? 96,000. How much should be booked? 84. That means more expense you need to book or you need to reverse. Reverse. That means here employee compensation expense to be recognized / reversed we will write. Sorry, my bad. I thought reversal was not there in this problem. Expense to be recognized / in bracket may we will write reverse. Sometimes you need to recognize, sometimes you need to reverse depending on scenario to scenario. Expense to be recognized / reversed in current year. Now I will write 5 is equal to 3 minus 4. That is same. Just one word reverse you should have added in bracket. That's it. So 3 is how much, sir? For the last column 3 is 84,000. 4 is how much? 96,000. That means final number what are you getting? 12,000 of what? Recognition or reversal? Or positive or negative number? Positive number means recognition. Negative number means reversal. Here it's a case of reversal. Meaning 12,000 expense you need to reverse. Based on this only I will pass my journal entry. That's all. So if you got this table right, more than 90-95% of the percentage of the marks in your pocket already. Journal entry is very simple. Just this portion. You want me to zoom in on any portion now? No. Everyone has copied. Oh, no, I'll wait for online if anyone has to copy any portion. Sir, how did we get 96,000 in the third column they're telling? Okay. How did we get this 96,000 guys? First of all, what is this 96,000? Expense recognized previously. You are in year 3. So previously means year 1 and year 2. Year 1 mein how much expense did you recognize? 48. Year 2 mein how much expense have you recognized? 48. So first year you recognized 48. Second year again you recognized 48. That means the total expense recognized is 96,000. That's how I got it. Or if you don't want to do so much, check this. The same thing gets updated here. If you like formula means. Okay. This you don't have to mention in your examination. For your reference, if you want, you can write it down. Hope it's clear. Okay, I'm thinking it's clear for her. Okay, next. Next is what, sir? Journal entries. Sir, you need to pass journal entries for 3 years. Same journal entry for 3 years. But what I'm going to do is, in the interest of time, I'm going to do it in columnar format. In your study material, they'll pass it individually. Okay, according to me, if you present it in columnar format, you should be getting the marks because it's the same entry. I'm going to show you how to pass it in columnar. Individual entries, anyway, you know how to pass them. Columnar, I will show you. According to me, columnar presentation should be acceptable because we do this in CA final. Okay, here also, according to me, it should be okay. Or if you don't want to feel like, no, I don't want to do that, means pass it individually, no issues. You have to repeat it, that's all. I'll show you first what do I mean by that. Then you can just take a call. I'll write particulars. How this works is particulars. First year is ending on which date, sir? Or one moment, hang on. 1 minute. Don't write, hang on. It's at different dates they've exercised, no? Labs, no? Is there any different dates? Oh, June and all is there. Okay, then we'll have one date column. 1 minute, hang on. Okay, no problem. We can have one date. Okay, date column. Next, particulars. And then first year, year 1. Year 1 is ending on which date, sir? Or we can just write year 1. For your reference, you can write 31st March 20 X1. Or maybe have the particulars column a little big because that's where the entry will come. Year and all is for the amount. You can have a little bigger column for the second one. Year 1 is ending on 31st March 20 X1 now. Then year 2. Year 2 is 31st March 20 X2. And finally, year 3, which is 31st March 20 X3. Instead of passing the entries one parallelly, I'm going horizontally. That's it. Or rather, instead of vertical, I'm going horizontal. How this works? Check. Maybe first time you're doing columnar presentation. Okay, entry itself. Okay, first Fourth year not required. Oh, actually, when did they purchase?
After
When did they purchase? Oh, then we need to have that also. Yeah, we'll have that also then. I thought it came here on. We have that also. Year 4. Year 4 is ending on 31st March 20 X4. We are having this column because shares got purchased after, or rather it got purchased only in the 4th year. That's the reason. Thank you. Start off. Alright, first. Sir, what is the entry you passed previously? Can you tell me? If the vesting period is less than 1 year, what is the entry you passed? Bank account debit. Stop there only. In first entry only, can I write bank? No, why? Because will the employee get the shares on first year only or after 2.5 years is eligible to? I mean, will banking entry come in year 1? No. Can I book the expense? But yes. How much is the expense for year 1? I got it, sir. As per this table, 48,000. What is the name of that expense? Employee compensation expense. Expense means nominal account rule says what? Debited. Okay. So as on first journal entry, if you want, I'll write what the entry is: employee compensation expense account. Employee compensation expense account debit. Fine. 2, one dummy will be created. That name of the dummy you already know. Can you tell me? Employee stock option outstanding account. Employee the journal entry is employee compensation it is. Employee compensation expense account debit. Correct that please. Employee compensation expense account debit. Employee compensation expense account debit to, this is a dummy account which is employee, the name of the dummy is employee stock option outstanding or ESOP outstanding account also you can write. Fine now. This is the entry. Actually date column is irrelevant because for each one there is a different dates. No, instead of date you can make it a serial number. It's okay because each of them will be different dates. We'll write serial number. Serial number is 1. Okay, how much is the expense for a first year, sir? How much is the expense for first year? 48,000. That means this journal entry you will pass it for first year. Easy. Everybody, easy now. Okay, first year will complete off first. Next, employee compensation expense means it's an expense. Where will all expense go, sir? P&L. So what is the transfer entry? P&L account debit to what? To employee compensation expense account. This is the transfer entry for that expense. How much is the transfer entry? How much was the expense? 48,000. That means how much will you transfer? 48,000. Any confusion in this 2 entries? This is a dummy because when will the shares get purchased? After 2 years or after 3 years, whenever. Till then this account will have a balance. After that it will get closed. But have I come to that or am I still in first year? So till now it will have a balance. By the end of the problem you will see that account would have got closed. So far good. That's all you need to do in first. Okay. Though the company won't get money, they need to account expense. So they debit employee compensation expense. Can they credit share capital? Can they credit in the previous 2 problems? You credited share capital and you credited securities premium. Can I credit share capital here? No, because has the company already allotted shares or yet to allot the shares? That's the reason you park this. But expense you need to account. Correct? That's the reason you park this in a dummy account. Name of that is employee stock option outstanding account. Easy. Alright. First year drama over. Now second year ka. Second year, do you have any expense, sir? Check your table. How much is employee compensation expense to be recognized or reversed? Recognized. How much recognition for year 2? 48,000. That means what is the entry? Employee compensation expense account debit 48,000. Can you credit share capital? No, because shares have got vested in year 2 or later. That means what will you credit? A dummy. The name of the dummy is employee stock option outstanding. If you don't do columnar format, what you have to do? Pass the same entry again. But when you do columnar format, I will just write 48,000, 48,000 over. Saving time. Narration is a must. Actually, this one I should have given a narration. Here, what you can write as narration? Being employee compensation expense recognized. That's all. Being employee compensation expense recognized. Simple. No fund, no hyphen or journal entries and all, hyphen or narrations and all. Being employee compensation expense recognized. What is the narration for this? Being what? Being employee compensation expense. Being employee compensation expense transferred to P&L. Transferred to P&L. Basic narration. No hyphen. Serial number मतलब? हाँ, that is okay. That's fine. Column, the moment you give it columnar, its indication is every year same entry will come. That's the reason amount different. This is an acceptable presentation in CA final. Even our study material does this. Okay, but CA inter may they have not put it up, but according to me it should be okay. Fine. Again, I'll leave you choice to ultimately to you. Okay, you know how to pass now. Individually, you know any which way. Here I'm showing you a columnar. That's it. So second year, how much is the expense? 48,000 only. That means same entry. So employee compensation expense account debit to employee stock option outstanding. Employee compensation is an expense. Where it will go to? P&L. So that means what is the transfer entry for second year also? Same. P&L account debit to employee compensation expense account. How much amount?
48.
Same 48,000. 48,000. So 2 years drama over. Yes. Okay. Can I come to the third year? Come to the third year, sir. Come to your table. Third year may you have expense recognition or you have expense reversal. You have an expense reversal. Yes. For reversal, there is a separate entry. We will pass an entry for this. Journal entry number 3, serial number 3 will write. Okay, 1 minute, hang on. Or maybe I'll explain this. Sir, when you are recording the expense, what account do you open? Employee compensation expense. Now check this entry only. You open employee compensation account. You debited it. How much? 48,000 for first year. Look at your second entry. What did you credit? Employee compensation expense. That means what is the balance in that account? 48,000 you debited. 48,000 you credited first year only. What is the balance? 0. So if you add these two entries, what are you going to get effectively? If you add these two entries, what are you getting effectively? P&L account debit to employee stock option outstanding. Yes, that is the entry for what? Recognizing the expense. Reversal will be ulta. That means what it will be? Don't write. Hang on. Employee stock option outstanding account. Oh, space silva. Should have made it a little bigger. Employee stock option outstanding account debit. Reversal will not be done through P&L. It goes off to general reserve. Both are any which way? Free reserve. Actually, the reason for this is you'll learn more about this in CA final. If I talk also, probably you'll not understand. Can I say a few words? Is it okay? Okay. You'll learn that there is, according to you, what are financial statements? Or can you name me some financial statements for me? Balance sheet, P&L, cash flow, trading, cash flow statements, notes to accounts. Yes, this is what you have done. Next stage, you'll learn that there is one more component. Statement of changes in equity, SOC. We call it statement of changes in equity, SOC. Not required to remember it, just sharing. What that says is, as per SOC, what you will capture in that is any transaction between the company and its shareholders. Any transaction happening between the company and its shareholders should be captured in statement of changes in equity. Okay. So this is a transaction, this is a share transaction. I mean, this should not be shown in P&L. They're saying it should be shown in SOC. SOC means your reserves in surplus. You prepare reserves in surplus. No, instead of reserves in surplus, we prepare a note. That we call it a SOC. It should be captured there. That is the reason we don't transfer this to P&L. We show it in general reserve. Is it okay? Because if you show it in P&L, it will come off in P&L. No. But these sort of transactions should be captured in reserves in surplus. Hence, directly we transfer it to general reserve. That and few other things are also there. So much not required. Are we okay? Just remember this. Okay, you mug it up for the time being. It is okay. Because I have to tell you in detail. And that is not even there in the syllabus. I'm sure you'll nod off for the time being. Okay. So much not required. You have to go at stage by stage only. No? So what is the entry here? Instead of crediting P&L, you're crediting general reserve. But as far as you're concerned, general reserve and P&L are any which way? Free reserves. Are we okay? So far good? How much you need to reverse, sir, as per your working note? 12,000. That means which year? First year you need to reverse, No. Second year you need to reverse, No. Second year or third year? Third year. Third year you will pass how much? 12,000, 12,000. Don't forget to write it twice, okay? Employee stock option debit, 12,000. To general reserve, 12,000. That's how we read this columnar entry. Don't just write it once. Debit, credit like that. You don't have to leave the space. You can write it parallelly. That's acceptable, understandable. Okay, or pass individually, your call. Easy. Will this entry come in the third year, sir? Will this entry come in the third year? Why? What is this entry for? Recognizing the expense. Third year, are you recognizing the expense or are you reversing the expense? That means will this entry come? If this expense entry is not there, means will this come? No. So that those two entries, dash dash blank. Easy peasy. Over. Third year over. Then what happened? Come to the problem. Then what happened? Finally, 600 options got exercised. On which date? 30th June 20x3. 30th June 20x3 means third year or next year? Year 4. That means I have to pass year 4 ka entry. Again, expense recognition. No. Employee, their ESOP expense will only be recognized till the vesting period. Exercise period can be however long if you want. That is irrelevant to us. Guidance note, as per guidance note, you have to amortize the expense over the vesting period. Is vesting period over? By the end of year 3, your vesting period has been completed. So that means expense recognition will stop at year 3. Year 4, what will come? Employees have bought the shares. So that buying entry we need to pass. That's all. Is a alright. Buying date is what, sir? Buying date is what? 30th June 20x3. Okay. So now employees have purchased the shares. Narration they're asking. Okay. Narration only I forget. Because for me, narration and all is not even a big deal. No? So I kind of forget it. It's okay. Please ask. Thank you. Somebody has asked it. He's like, hey, bariyappa ni heng marti antar. He's not saying that, but he's meaning that. That's it. Alright. So narration is being reversal of employee compensation expense. Correct. Being, sorry, sir. Okay. Being a reversal of employee compensation expense. I'll write COMP as in compensation expense. Or employee compensation expense reversed, whatever way it is. Write it in your own words, no worries. Or being employee compensation expense reversed and transferred to general reserve. Like that also. You want to add masala means add. Who's telling you no? Don't add too much masala and change the whole meaning, that's all. Ashte. Okay, so year 4 can we come to? Year 4 is what? Employees have purchased the shares. If you want instead of 31st March, what we can write? Buying date only, or let it be, it's fine. Okay, employees have purchased the shares. That means company will get money. So that means what is the fourth entry I need to pass now? We will, since company has got the money, now they will debit bank. So that means a bank account debit. How many shares did they buy, sir? 600. On one share, how much are they paying? What is the exercise price given in the question? 40. So 600 into 40, you do how much you're getting? When did they buy? Year 1, na? Year 2, na? Year 3, na? No. Year 1, 2, 3, dash, 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 dash. So year 4, may you should write. That is one thing you should bear in mind for columnar format, okay? Correct column you should update. Year 4, if you update in year 3, gone. So that is one thing you need to watch out for. So how much is this? 600 into 40 is 24,000. So bank account debit 24,000. Is a 2. What did the company give it to the employees? It issued equity shares. If the company issues equity shares, what will they credit? To equity share capital. How much? 600 shares. Each share ka face value is 10. So you'll multiply it by 10. One line I've left, okay? Just in case you're wondering. I've left one line. You also leave or watch the entry and then write. I'll tell you why I've left. Will this entry come in year 1, 2, 3? No. Equity share capital, you will credit how much? 6,000. Yes. To what? To securities premium. That is same only. That will not change. To securities premium. How many shares issued? 600. What was the market price of the shares they told in the question? 160. What is the face value of one share, sir? Sir, they have not given face value only. Sir, I told you on, I think somewhere. If they don't give the face value, we take it to be. For equity shares, we take it as 10. For preference shares and debentures, we take it as 100, just as a convention. Fine. And here, sir, I want to assume 100. Please don't assume. Why? Sir, exercise price is only 40. You can assume face value 100. Would that be logical? So in this problem, it is more logical to assume it as 10. Generally, it is taken to be 10. Maybe that's the reason they missed out. Okay. So face value of the share is 10. Market price of the share was 160. So that means what is the premium? On one share, the premium is 150. So 600 into 150, you do how much is this? 90,000. So securities premium, you will credit in column number 4, 90,000. Journal entry matched. Now debit is 24,000. Credit is these two. That means you have to debit something. Hang on. Check your previous entry. What you used to debit? You used to write bank account debit. Here what you used to write? Below that. Employee compensation expense. Can you write employee compensation expense again, or all employee compensation expense already recognized? It has already been recognized. Yes. That means can you debit employee compensation expense? No. But you have one dummy, you remember? What is the name of the dummy? Employee stock option outstanding. Here it's been exercised. No? Shares are exercised. Is that dummy required or you can close out? It has credit balance because you're being crediting here from the beginning. Yes. So you debit here. What will you debit? Employee stock option outstanding account. Employee stock option outstanding account debit. Employee stock option outstanding account debit. How much? 600 into, you can write it as balancing figure, or you can just write 120. No. It's 120, not 80. Haven't told 80 here. 120 you told. Okay, fine. 600 into, why 120? Sir, what are you booking in this employee stock option outstanding? A compensation expense, which is loss. You check your table. How much is that loss per share? 120 only, no? So this will be 120 only. Yes. Or write it as balancing figure if you don't want to do much calculation. So 600 into 120 if you do, you're going to get 72,000. So these are your debit. So debit side total is 96,000. These are your credit. Credit is also 96,000. Got it? Sir. Employee compensation expense no, or employee stock option outstanding no, account no, has not closed out, sir. Somebody is telling. Is that right? Check. It should have a balance. How much balance it should have? No. It should have 12,000 balance exactly. Tell us. Check your calculator. If you don't get 12,000, no, throw your calculator. Yes, sir. 12,000 it should have. Check. How to check? That also will tell you. Employee stock option outstanding account. First time, how much did you credit? 48,000. Second year, how much did you credit? 48. So 48 plus 48 is how much? 96,000. Third year, what did you do? You debited it because you reversed the expense. How much did you debit? 12,000. So 96,000 minus 12,000 you do. How much you getting? 84,000. In the last entry, you debited again employee stock option outstanding. How much did you debit? 72. Minus 72,000 you do. How much you getting? 12,000. That is the dummy. Is that account required anymore? Why it's required is, sir, how much we thought employees are going to buy? Check the screen. 700. But how many eventually purchased? Only 100. That means 100 more options are getting lapsed. And the loss on one share is how much? 120. How many more shares got lapsed? 100. 100 into 120 is 12,000. That's how I said it is 12,000. If you don't want to do so much calculation, what do you have to do? How much our balance is there in employee stock option outstanding? Close it. Doesn't matter how you get the right answer. No, as long as you're getting the right answer, you'll get marks. Fine, no. Get it as as a thinking process or as a mug-up process. It's okay, whatever you're comfortable. So is that employee stock option outstanding required or we can close? Journal entry, it has still a credit balance. How do you close out? Debit. So that means the journal entry is employee stock option outstanding account debit. If you want to calculation will be 100 options more got lapsed. On one option, the loss is 120. Which year you will pass? First year, second year, third year or fourth year? Fourth year. You will debit employee stock option outstanding by 12,000. Where will you transfer all this balance? Reversal mein, where did you transfer? To general reserve. So write that to general reserve. Reversal will happen always through the general reserve. To general reserve, 12,000. Again same. First year, second year, third year, nothing. Fourth year, you will write 12,000. That's your scheme of entries. If you do it individually, you will get maybe 2-3 entries more. But sometimes they will give vesting periods 4.5 years. That time it could become real lengthy. Same entries only, but just that length of the solution will be on the higher side. That's all. Yes, all of us got it. Okay, narration. Somebody is behind narration. What is this narration? They didn't ask. I'm only writing. What is this in narration for this? Fourth entry, if you want narration, what will you write? Being 600 options exercised, accounted. Or you can write here, being 600 ESOP exercised. Being 600 ESOP exercised. That is the entry for this. 600 options got purchased. No? Okay, last entry is what? Being employee stock option outstanding transferred to general reserve. Being employee stock option outstanding account balance transferred to P&L or transferred, or you can just stop it transferred also. Transferred to general reserve. Or also you can write being 100 options lapsed. That way also you can present the narration. Either ways, it's okay. Understood the question now? This is what we're going to do in 2 or 3 more problems. Fine. This is actually maybe a good question. I'll read out this question. For the last sum, how many shares was given to the employees? She's saying we gave option to buy 20,000. But employees purchased only 16,000. So that means we passed entry only for 16,000. For that 4,000, we did not pass any entry at all. Check. We were passed entry only for 16,000. But here, they're telling, sir, how much option was given to the employees? 1,000. That means how much entry did you pass initially? How much options did you, how did you get this 48,000? By considering what? How did you arrive this 48,000? By considering 1,000. That means here we have passed the entry for 1,000, sir. Partiality, she's asking. And here I don't know. Okay. They're asking what is the logic of this? Sir, it's a simple thing. There, vesting happened within 1 year. That means clearly I know that only 16,000 shares are getting purchased. So even if I book an expense for 20,000, I need to reverse the expense in the same year for 4,000. Why is that unnecessary drama? Book it on the same day, reverse on the same day, required? No. But here, why we book for 1,000 is, on this particular day, 31st March 20x1, how many shares company thought they will buy? 1,000. They are not astrologers. No. They can make only a reasonable estimate. Estimate should be 100% right, or it could go wrong a little bit there. They thought one favorite employee, he will stick around. He told, very offer sick. Possible, employees may quit. Yes or no? So, that's the reason we account for how many other options we feel. That's the reason, look at this word correctly I've written. Number of options expected to vest. Here only company thought, if company is expecting only 700 is going to vest, means instead of 1,000 I'm going to write 700 only. But based on this information, what is the reasonable conclusion the company would draw? That 1,000 shares would be purchased by employees. Hence I booked the expense for 1,000. But here I got to know what? 300 options are lapsed. Now what will I do? I booked the expense only on 700. Are you okay? So this 84,000, how did I get? 700 into 120 I did. Check. Did I do it for 1,000 here or did I do it for 700? 700, because 300 options I've got lapsed. That's the reason I booked the expense only on 700. If I book more expense means reverse it. So here I will have the lack of information. Lack of concrete information basically sure information I will not have. Hence, based on expectation, I'll keep doing the accounting. If my expectation goes wrong, then I will correct it whenever I get to know about it. This 100 shares ka lapsed, when did I get to know? I booked the expense here 700. Why? Actually 600 only got purchased. Why did I book 700? Because as on 31st March, company still thought 700 of them are going to purchase. But in June, 3 months later, on 30th of June 20x3, what did they get to know? Only 600 got purchased and 100 got lapsed. Hence, on 30th June 20x3, I reversed the expense of extra. That's the thing. Are we fine? So it is expectation accounting. So this is how practically also people do. How much ever you expect, that much only you account it. Like that. All right. So that's it for the, we'll take a break and then we will probably resume with the remaining questions. Yeah. All right.